When people think about investing, they often picture the excitement of the stock market. Headlines are filled with stories of companies soaring to record highs or crashing overnight. While stocks often steal the spotlight, there's another investment that quietly plays a crucial role in building long-term wealth: bonds. Bonds may not generate the same excitement as high-growth stocks, but they provide something equally valuable: stability, predictable income, and protection during uncertain times. In fact, many of the world's most successful investors rely on bonds as the foundation of a well-balanced investment portfolio. So what exactly is a bond? The simplest way to think about a bond is as a loan. Instead of borrowing money from a bank, governments, corporations, or municipalities borrow money directly from investors. When you buy a bond, you're lending your money to the issuer. In return, the issuer promises to pay you regular interest over a specific period and then repay your original investment when the bond reaches maturity. Unlike buying shares of stock, where you become part owner of a company, purchasing a bond makes you a lender. That distinction is important because lenders receive fixed interest payments regardless of whether the company's stock price rises or falls, provided the issuer meets its obligations. These regular interest payments are known as coupon payments. Because they are usually fixed, bonds are commonly referred to as fixed income investments. Let's look at a simple example. Imagine you purchase a government bond with a face value of $1,000 and an annual interest rate of 4%. Every year, you'll receive $40 in interest, often paid in 2 installments of $20 every 6 months. If the bond has a 30-year maturity, you'll continue receiving those payments for 30 years. At the end of that period, you'll receive your original $1,000 back. This predictable stream of income is one of the biggest reasons investors include bonds in their portfolios. However, there's another important aspect of bonds that every investor should understand. Although the interest payments remain fixed, the market price of a bond can change. Bonds are traded in financial markets just like stocks, and their prices rise and fall based on several factors. The biggest influence is interest rates. Bond prices and interest rates have an inverse relationship. When interest rates rise, newly issued bonds begin offering higher coupon rates. Existing bonds with lower interest payments become less attractive to investors, causing their market prices to decline. On the other hand, when interest rates fall, older bonds paying higher interest become more valuable because they offer better returns than newly issued bonds. As a result, their prices increase. Understanding this relationship helps investors make smarter decisions about when to buy or sell bonds and explains why bond values can fluctuate even though their payments remain fixed. Now, let's explore the different types of bonds available. Government bonds are generally considered the safest investments. In the United States, Treasury bonds are backed by the full faith and credit of the federal government, making the likelihood of default extremely low. Because of this safety, government bonds usually offer lower interest rates than other types of bonds. Corporate bonds are issued by businesses seeking to raise money for expansion, operations, or refinancing existing debt. Since companies carry more financial risk than governments, corporate bonds generally offer higher yields as compensation for that additional risk. Municipal bonds are issued by states, cities, counties, and local governments to finance public projects such as schools, highways, hospitals, and infrastructure. One major advantage of many municipal bonds is that the interest earned may be exempt from certain taxes, making them especially attractive to investors in higher tax brackets. There are also specialized categories of bonds. High-yield bonds, often called junk bonds, are issued by companies with lower credit ratings. They pay higher interest rates but come with a greater chance that the issuer could default. Inflation-protected securities are designed to help investors preserve purchasing power when inflation rises by adjusting the principal value over time. International bonds provide exposure to foreign governments and companies, giving investors another way to diversify globally. Speaking of diversification, this is one of the strongest reasons to own bonds. No investment performs well under every economic condition. Stocks can deliver impressive long-term growth, but they also experience periods of significant volatility. Historically, bonds have often behaved differently from stocks. During economic downturns or periods of market uncertainty, investors frequently move money into safer assets like government bonds. At the same time, central banks often lower interest rates to stimulate economic activity, which can increase bond prices. This means bonds may help offset losses when stock markets struggle. That's why many financial advisors recommend balanced portfolios, such as allocating 60% to stocks and 40% to bonds. While the exact allocation depends on an investor's age, goals, and risk tolerance, combining both asset classes has historically reduced overall portfolio volatility while still delivering attractive long-term returns. Bonds also provide dependable income. For retirees or anyone seeking consistent cash flow, predictable coupon payments can reduce the need to sell investments during market downturns. Instead of relying solely on rising asset prices, bond investors receive actual cash payments throughout the life of the investment. Despite these advantages, bonds are not completely risk-free. Interest rate risk is perhaps the most well-known. Rising interest rates can reduce the market value of existing bonds. Credit risk depends on the financial strength of the issuer. While government bonds generally have very low default risk, lower-rated corporate bonds carry a greater possibility that payments could be delayed or even missed. Inflation presents another challenge. If inflation rises faster than the interest earned on a bond, the investor's purchasing power declines even though the payments continue. There's also reinvestment risk. As bonds mature or coupon payments are received, investors may need to reinvest their money at lower prevailing interest rates, reducing future income. Liquidity risk can also affect certain bonds that don't trade frequently. In these cases, selling before maturity may be more difficult or require accepting a lower price. Fortunately, investors have several ways to include bonds in their portfolios. Some prefer purchasing individual bonds directly through brokers or government programs. This approach allows investors to hold bonds until maturity and receive their principal back, assuming the issuer remains financially sound. However, for many investors, bond mutual funds and exchange-traded funds, commonly known as ETFs, offer a more convenient solution. These funds provide instant diversification by holding hundreds or even thousands of bonds managed by investment professionals. Rather than relying on the performance of a single issuer, investors gain exposure to a broad basket of fixed-income securities. Another popular strategy is called a bond ladder. Instead of investing all your money into bonds that mature at the same time, you purchase bonds with staggered maturity dates. As each bond matures, the proceeds can be reinvested into new bonds, helping reduce interest rate risk while maintaining regular access to cash. Credit quality is another important factor to evaluate. Independent rating agencies assign credit ratings that help investors assess the likelihood that an issuer will repay its debt. Bonds with top ratings, such as AAA, are considered high quality and carry lower default risk. Bonds rated below investment grade typically offer higher yields because investors demand additional compensation for taking greater risk. Tax planning also plays a role in bond investing. Municipal bonds often make sense for taxable investment accounts because of their potential tax advantages, while taxable bonds may be better suited for retirement accounts, where investment income can grow tax-deferred. Experienced investors also monitor the yield curve, which plots interest rates across different bond maturities. An inverted yield curve, where short-term interest rates exceed long-term rates, has historically been viewed as a warning sign of a possible economic slowdown or recession. Although bonds rarely produce spectacular overnight gains, they excel in areas that matter just as much for long-term financial success. They help preserve capital, provide reliable income, reduce portfolio volatility, and create a more balanced investment strategy. Ultimately, successful investing isn't just about maximizing returns. It's about managing risk, staying disciplined, and building wealth that can withstand changing market conditions. Bonds continue to prove their value because they offer something every investor needs: financial stability. Whether you choose government bonds for safety, corporate bonds for higher income, municipal bond for tax efficiency, or diversified bond funds for convenience, adding fixed income investments to your portfolio can strengthen your financial foundation for years to come. If you found this video helpful and learned something new about bonds and investing, don't forget to give it a thumbs up, share it with friends and family who are building their financial future, and subscribe to the channel for more easy-to-understand investing, personal finance, and wealth-building content. Thanks for watching, and I'll see you in the next video.